The economist's ultimate tool. Dynamic Stochastic General Equilibrium, DSGE models, are the leading, transparent tool for assessing major macroeconomic policy changes. Yet they failed to predict the 2008 financial crisis, learn how DSGE modelers are now incorporating financial frictions and addressing the zero lower bound to improve and sharpen policymaker judgment worldwide. Welcome to the deep dive. That quote, it really just perfectly frames the big tension here, doesn't it?
It absolutely does.
We're focusing today on these things called DSGE models. They're these giant, incredibly intricate simulation engines that pretty much every major central bank uses. The Fed, the IMF, you name it.
They're essential. They're the only tool we really have for answering these massive what-if questions.
Yeah.
What's the actual quantitative impact if we switch from, say, inflation targeting to price level targeting? You can't run that experiment on a real country.
Right. But as that quote lays out, this incredibly sophisticated tool had, well, a catastrophic blind spot in 2000.
A huge one.
So today we're going deep into this apparatus. We want to understand its foundations, the details of why it failed, and maybe, most importantly, the radical, data-driven evolution it's been through since the Great Recession.
And our goal is to really demystify these models. We want to show you that DSGE modeling isn't some static, dusty thing. It's a living, organic enterprise. It's constantly evolving.
Okay, that's a big mission. So let's start with the basics. Why even use a model at all? If we can't run real-world experiments on economies, why not just study history or use, simpler methods based on correlation?
That's the fundamental question. And the reason is when you change policy, you guess. You change the rules of the game.
You change the whole system.
Exactly. History gives you context, but no two crises are identical, so those comparisons are weak. And what economists call reduced form models, they're great at finding correlations, at summarizing data, but they're really poor at predicting what happens when you make a big structural change.
So if I'm getting this right, a reduced form model tells us what happened last time, but it can't really tell you what will happen when you change the underlying system itself.
Precisely. You need DSGE models because they are structural. And they offer two really strategic virtues that overcome those weaknesses. First, and this is key, is transparency.
Transparency.
These models are open architecture. All the assumptions about how households and firms behave, they're laid out in detail. This makes them easy to criticize, makes inconsistencies easy to spot, and, critically, makes missing forces like a giant shadow banking sector easy to identify later.
So the transparency itself is what drives improvement.
It's the engine of improvement.
Mm-hmm.
And the second virtue is the requirement for microeconomic foundations.
Okay, what does that mean in practice?
Well, older macro models often suffered from something called observational equivalence. It meant that several completely different theories could all produce the same patterns in the big aggregate data. You couldn't tell which theory was right. DSGE models force you to incorporate specific microeconomic data, institutional facts, right into the design. It anchors the model to some kind of verifiable reality, and it fundamentally breaks that equivalence problem.
So they're built from the bottom up, based on detailed observation, which allows for much better scrutiny. And I love that quote you brought up earlier, that these models aren't supposed to replace human judgment.
No, not at all. They're meant to improve and sharpen that judgment. That's the key. They don't make the final call, but they give you quantitative answers that simpler models just can't deliver without falling back on, informal, less transparent judgment calls.
All right, let's look at the engine they were using before 2008. The early attempts were these real business cycle models, or RBC models. They were the original chassis, but they had some pretty significant limitations, right?
Oh, they did. Big ones. The RBC models from the 80s, they assumed perfectly competitive markets, and the only shocks were like technology shocks.
So monetary policy didn't matter at all in those models.
It was completely irrelevant, and this view, it just hit a wall. They couldn't explain the volatility we see in the labor market, and most critically, they were totally mute on questions about money and monetary policy, just inconsistent with basic economic history going back to David Hume in 1742.
So that's where the new Keynesian or NK models came in. They kept that structural RBC architecture, but they bolted on something absolutely essential.
They added nominal frictions.
Sticky prices and sticky wages.
Exactly. And that creation led to the canonical NK DSGE model. It satisfied what we call the Fisherian property. In the long run, money only affects prices, not real output. But because of those sticky prices and wages, Monetary policy absolutely matters in the short run.
And this is where the engineering gets really fascinating, to get these new models to actually reflect real-world data. I mean, if you look at how an economy responds to an interest rate shock, output and consumption don't just jump up.
No, they rise slowly and peak in this kind of hump shape.
Right, that hump shape. So modelers had to introduce these very specialized features to replicate that.
That's right. If you look at the Cristiano, Eichenbaum, and Evans 2005 prototype, the CE model, it shows you the lengths they had to go to match that shape from the data.
What did they have to do?
They needed three major fixes. First, something called habit formation in consumption. They couldn't let consumption just leap up after a rate cut, so they assumed that the satisfaction you get from your consumption today
Depends on what you consumed yesterday.
depends positively on what you consumed in the past. It forces people to raise their consumption slowly.
That sounds a little bit like an economist's version of putting duct tape on a leak.
Maybe, but you could call it data-motivated duct tape. Second, they needed investment adjustment costs.
To stop investment from surging immediately.
Right. If you make it free for firms to change the rate of investment, it would just explode after a shock, which that doesn't happen. So they introduced costs to slow it down.
And the third piece, sticky wages. That was crucial for the whole thing to hold together.
Oh, absolutely essential. Sticky wages help dampen the movements in the inflation rate, which you need to keep the model lined up with the kind of stability we saw in post-war U.S. data.
Okay, so before 2008, you've got these incredibly calibrated, complex machines. They're successfully capturing decades of post-war data, the effects of normal monetary policy. This must have generated enormous confidence.
It did.
And then the storm hits. What was the exact failure? Why did these sophisticated models miss it?
The failure it was a catastrophic blind spot. But it wasn't just the models. It reflected a broader profession-wide lapse. Modelers, regulators, academics, we all pretty much overlooked the rise of the shadow banking sector.
A massive, poorly regulated sector.
Huge. And it was relying on short-term funding to back long-term assets with absolutely no protection against a liquidity run.
And the crisis wasn't triggered by a standard monetary shock or anything the models were built for. It was a systemic financial breakdown.
Precisely. The trigger was a rollover crisis in that shadow sector. It was caused by the fall in housing prices that started in mid-2006. These shadow banks were holding toxic mortgage-backed securities, and suddenly they couldn't refinance their short-term debt.
So they were forced to sell assets at fire sale prices.
Exactly.
Yeah.
Now, to be fair to the modelers, up until the Great Recession, most post-war recessions in the U.S. and Europe, they just hadn't been clearly tied to financial market problems.
Like the '87 crash or the dot-com bubble?
Right, the '87 stock market crash, the 2001 tech bubble bursting, they had relatively minor effects on the real economy. And even the earlier DSGE models that did include some financial fictions, like the famous financial accelerator,
They didn't show a big effect.
they only suggested a modest quantitative effect. So the modelers prioritized the frictions that the aggregate data was screaming at them about.
That context is so important because DSGE modeling is defined by this interaction with data. The crisis just fundamentally changed the whole research agenda overnight. So how did they start retrofitting the models?
The evolution has really gone down two major parallel tracks. The first was obviously incorporating much more detailed financial frictions.
Right.
And that work itself split into two types: modeling frictions inside the financial institutions, and then frictions associated with the borrowers.
So inside the banks first.
The Gertler and Kiyotaki model from 2015 is a great example. It shows how just a small decline in asset values like houses could push these shadow banks into a crisis. If creditors think you might fail, they'd rather just grab your assets at a fire sale price than roll over your debt.
And that creates an instant rollover crisis, a systemic collapse.
Exactly. And then on the borrower side, you have the role of risk.
Risk shocks.
Yes. A 2014 paper by Cristiano, Mato, and Rostagno was really influential. They looked at risk shocks, basically, fluctuations in the risk premium that firms have to pay to borrow. And when they included detailed financial data in their model, they found that these risk fluctuations account for a massive 60% of U.S. business cycle fluctuations.
60%, that's huge.
It dramatically increased the importance of financial data inside these models.
Okay, so that's the first strand, financial frictions. What's the second big evolution?
The second major strand addresses the huge nonlinearity that was introduced when the economy hits the zero lower bound, the ZLB.
When the Fed hit 0% interest rates in December 2008.
And the rules of macro policy just that's way. They completely flipped.
How so?
Okay, so normally, if the government increases spending, that leads to a bit of inflation. The central bank sees that, follows its rule, the Taylor rule, and the real interest rate goes up. That makes borrowing more expensive, so private consumption and investment go down. We call that crowding out.
And the multiplier is less than 1.
Typically, yes.
Okay.
But when the nominal interest rate is stuck at zero,
That constraint changes everything.
completely. Now, government spending still raises inflation, but since the nominal rate is stuck at zero, rising inflation actually lowers the real interest rate.
Which stimulates private consumption and investment. It crowds in spending.
Exactly. And the DSGE analysis on this showed that when the ZLB is binding, the government spending multiplier can be much larger than 1. This finding provided some crucial, immediate policy advice during the crisis.
The ZLB also led to new policies, like forward guidance, with central banks promising to keep rates low for longer.
But that's been tricky for the models, hasn't it?
A huge challenge. Modelers found that this policy was implausibly powerful in the standard models. It created something called the forward guidance puzzle, which is still a major area of research.
And finally, there's a move away from the idea of a single rational person representing the whole economy.
Right, the representative agent. We're seeing modelers move toward what are called Hank models, heterogeneous agent New Keynesian models.
So why abandon the representative agent after all this time?
Because the microevidence was just overwhelming. The main way we thought monetary policy worked, by getting a certain type of household to reallocate consumption over time, it just seemed empirically weak.
Most people can't just do that. No. Most households face borrowing constraints. They face income risk. They can't just smoothly move consumption around because of a small interest rate change. In these Hank models, the main effect is more of a multiplier-type process. It's the firms and the non-adjusting households reacting to changes in demand from the very small group who can adjust.
So, given all this complexity, the constant updates, how are these models actually used by policymakers in the real world?
They are absolutely central to quantitative decision-making. At the Federal Reserve, for example, DSGE models play a key role in generating scenarios for what's called the Teal Book A. That's the staff's economic forecast.
And for optimal policy recommendations.
And for model-based estimates of optimal policy, yes. They're also used for Teal Book B, where they generate the precise quantitative implications of 3 different policy options, from dovish to hawkish, that the committee has to weigh. They are the backbone of quantitative advice all over the world.
This evolution really seems to counter some of the external critiques you hear, like the argument that DSGE models are stuck using old techniques or simple linear approximations.
Exactly. The modern literature is explicitly tackling nonlinearity with the ZLB and heterogeneity with Hank. They are not limited to simple approximations, and they use formal, rigorous econometrics. The whole process is highly responsive to shortcomings and criticism.
So let's circle back to where we started, the question of prediction. After all this evolution, after adding financial frictions, heterogeneity, nonlinearity, will the next generation of DSGE models predict the time and the nature of the next crisis?
Okay, we doubt it.
Really?
The history of economics just suggests there's no surefire way to see the future. The failure in 2008 was a profession-wide failure to even see the shadow banking sector. DSGE models are sophisticated tools for policy analysis under specific assumptions. They're designed to help us navigate the known terrain better, not act as crystal balls for unknown threats.
That's a crucial distinction. And since we know these tools won't predict the exact timing, but they will keep evolving based on the financial metrics we feed them, let this be your thought for today. We talked about how older models suggested only a modest effect from financial frictions, yet newer models found that risk shocks account for 60% of the business cycle once you include financial data. So beyond the balance sheet constraints being modeled now, what specific emerging financial metric, maybe something related to complexity or leverage in non-bank entities, or even climate risk pricing, what might be the next crucial friction that DSGE modelers have to integrate to truly reflect the complexity of modern markets? Thank you for joining us for this deep dive into the evolution and continuing utility of DSGE models. We'll see you next time.